Welcome to Financial Preparedness Network. And today we're going to be talking about option Greeks. 4 factors for measuring risk. An option price can be influenced by a number of factors that can either help or hurt traders depending on the type of position they have taken. Successful traders understand the factors that influence options pricing, which include the Greeks, a set of risk measures named after the Greek letters that denote them, which indicate how sensitive an option is to time value decay, changes in implied volatility, and movements in the price of the underlying security. These 4 primary Greek risk measures are known as an option's theta, vega, delta, and gamma. What is theta? The term theta refers to the rate of decline in the value of an option due to the passage of time. It can also be referred to as time decay of an option. This means an option loses value as time moves closer to its maturity. As long as everything is held constant, theta is generally expressed as a negative number and can be thought of as the amount of which by an option's value declines every day. Vega. Vega is the measurement of an option's price sensitivity to changes in the volatility of the underlying assets. Vega represents the amount that an option contract's price changes in reaction to the 1% change in the implied volatility of the underlying asset. Volatility measures the amount and speed at which price moves up and down and can be based on recent change in price, historical price changes, and expected price moves in a trading instrument. Future dated options have positive Vega, while options that are expiring immediately have negative Vega. The reason for these values are fairly obvious. Option holders tend to assign greater premiums for options expiring in the future than those which expire immediately. Delta. Delta is the ratio that compares the change in the price of an asset, usually marketable securities, to the corresponding change in the price of its derivative. For example, if a stock option has a delta value of 0.65, that means that if the underlying stock increases in price by $1 per share, the option on it will rise by 65 cents per share, all else being equal. Delta values can be positive or negative depending on the type of option. For example, the delta for a call option always ranges from 0 to 1 because as the underlying asset increases in price, call options increase in price. Put option deltas always range from -1 to 0 because as the underlying security increases, the value of the put option decreases. And finally, the 4th Greek is gamma. Gamma is the rate of change in an option's delta per 1-point move in the underlying asset's price. Gamma is an important measure of the convexity of a derivative's value in relation to the underlying. A delta hedge strategy seeks to reduce gamma in order to maintain a hedge over a wider price range. A consequence of reducing gamma, however, is that the alpha will also be reduced. Gamma is the first derivative of delta and is used when trying to gauge the price movement of an option relative to the amount of it's in or out of the money. In the same regard, gamma is the second derivative of an option's price with respect to the underlying's price. When the option being measured is deep in or out of the money, gamma is small. When the option is near or at the money, gamma is at its largest. All options that are long position have a positive gamma, while all short options have a negative gamma. And I hope that brief description helped give you some knowledge on the Greeks, and if you would like to see more videos like this, please like and subscribe to our channel. Thanks.